right, friends, welcome to episode number 465 of the Follow the Money podcast. Today's episode entitled America's Debt Crisis. Well, we got a big debt crisis here in America, don't we? We've had one for a long time. The national debt has been outrageously high for many years. Going back to the very beginning of our work here at followthemoney.com, we released a book called Bankruptcy of Our Nation, which many of you have. In that book, we were talking about initially a $9 trillion national debt. Then, of course, it was rising and rising, even through the revised and updated editions of the book. And now today, in 2024, we stand at the cliff of an abyss of massive debt. And now the national debt here in the United States verging on $35 trillion. It's really difficult to believe. So today we're going to be diving deep into that topic that I believe is not only urgent, but very much underreported. And we're going to be talking about how this national debt could continue on this trajectory without any kind of intervention. We're going to see it soar to unprecedented levels even from here, which is going to cast a long shadow over our economy. It's going to cast a long shadow over our future here in America. But, you know, it's easy to toss around billions and trillions in conversation, but today we're going to talk about what these numbers really mean for you, for me, for the next generation. We'll talk about how we got here, who holds this debt, and the potential consequences if we continue on this treacherous financial path. We'll be talking about that. We'll be getting beyond the headlines. Of course, this is an election year, so this is kind of a political football that many people like to use during this time, even as we stand at this fiscal cliff, wondering what lies ahead. How does a nation awash in debt, how does it solve that problem? How does it get out of that situation? What are the things that you can do? We'll cover those things in segment 1. In segment 2, we're going to be talking about the latest things going on in the stock market. We'll provide a crypto update and also a stock market update. We'll look at a few charts together. All right, so let's buckle up because today's journey through America's debt landscape is essential for anyone who cares about the country's economic health and their own financial well-being. Let's get started. All right, welcome back to the show, friends. I'm your host, Jerry Robinson. Today, we're peeling back the layers of a topic that is looming large over our economic future. That is the monumental U.S. national debt. Now, brace yourselves, because these numbers are wildly staggering. We are currently sitting on a national debt of $34 trillion, nearly $35 trillion. Last time I checked, it was around $34.8 trillion. Yes, that is trillion with a T. That is not just a big number. That is a dangerous number. We go back to, say, 1980, and we see that America was the largest creditor nation in all of recorded history. And yet, since that time, America now stands as the greatest debtor nation in world history. Since, let's put things into perspective here, since January of 2020, just before the big pandemic that, of course, overtook the world, our national debt has surged by a whopping $11.5 trillion. It's as though every dollar spent and every policy enacted has been pushing us faster towards a fiscal abyss. And what's worse, we just got a report out from the Congressional Budget Office, its latest projections, and it shows no signs of this slowing down. We see deficits expected to balloon to nearly $2 trillion in the coming years. And we have to think to ourselves, what is causing this? What is driving this debt crisis? What is possibly possessing our leaders to drive this country into massive debt to the place where we can't afford to even pay the interest on the national debt, because that's looming. You may have seen recently that the interest on the national debt was competing with the amount of money we spend on defense every year. And the defense budget, of course, is nearly $1 trillion. So how in the world can we afford to pay for defense, to pay for Social Security, Medicare, Medicaid, and all of the other promises that have been made by Washington, and then also pay the interest on the national debt, right? Which is growing by the day. And of course, with interest rates elevated, that only compounds the situation for Washington. We often think of terms of how those interest rates impact us, but today we briefly think about how those rising and elevated interest rates actually aggravate the payoff strategy or the payment strategy on the interest for the growing national debt here in the United States. So what's driving the crisis? Well, it's not just one thing. It's a combination of irresponsible tax cuts like those that were passed under Trump in 2017 and unchecked spending across multiple administrations, including the Biden administration. Biden has continued on this path with his massive spending agendas, claiming that they'll be balanced out by taxing the rich. And yet here we are with a deficit larger than some of the world's entire economies. In fact, not just some, but nearly all. The only country that even rivals the amount of debt that we have in terms of sheer size is China. But you have to view its GDP on a PPP basis. That's the only way. If you look at it nominally, well, then our debt is practically twice the size of the Chinese economy in terms of output on an annual basis. Now, a national debt is not something new. America has carried a national debt since 1791. The only exception, by the way, is the year 1835, when President Andrew Jackson paid off the national debt and drove a stake through the bloodthirsty Second Bank of the United States. So there's nothing uncommon about government accumulating debt. That's very common. That's as old as the hills. But the problem occurs when government borrowing is permitted to get out of control. And that falls upon the populace. The voting population are the ones that are supposed to hold their leaders in check. That is the whole point of a constitutional republic that we have here in the United States. Yes, the politicians are to blame for spending the money, but who puts these people into power? Who continues to vote for them on a regular basis? Who continues to put the same policymakers into office knowing that they're going to continue spending and borrowing at record pace, right? Modern history provides a number of examples of governments allowing the practice of borrowing money at interest from the general public and from foreign creditors to become a dangerous game that's capable of destroying the nation's credit worthiness and economic credibility. We can go through history and see so many of these examples of nations that overborrowed and then ultimately were left with an unsustainable situation where they simply weren't able to pay off the debt. What does that lead to, by the way? Whenever you have a nation that can't pay off its debt, what does that mean? Well, it means that you have to cut spending and you have to raise taxes, right? Let's be clear about that. There are solutions to the national debt, but does America have the stomach and the will to actually implement those kinds of changes? That's the $1 million or let's say $1 trillion question. So who owns this debt, by the way? Well, a good chunk of it, over $7 trillion of this $35 trillion national debt, is held internally by U.S. government funds, but the rest is in the hands of foreign governments, American investors, banks, and then many other financial entities. And as this debt grows, so too does our vulnerability to market whims and foreign interests. This is where things get really nasty because the United States then ends up in a situation where it is living on borrowed time. It is living on thanks to the kindness of strangers who continue to loan money to it. And that puts America's path in of course, it puts us on a reckless path, but it also compromises potentially our leaders. It compromises our nation. But so too, it compromises the future for future generations, right? So let's be clear about the impact of this. This level of debt that America has taken on over time, slowly but surely, it just continues to rack up this debt with no repayment strategy in sight, no plan to get back on a more sustainable path. This level of debt, as we talked about, means higher interest payments, which now are nearly $900 billion per year. Can you imagine how much money that is? And what that money does, of course, those interest payments alone, forget all the other payments that the United States makes, just the interest payments, nearly $1 trillion per year. What does that do? Well, that crowds out money that could be used for investing in our future, right? It could be used for infrastructure. It could be used for education. It could be used for spurring innovation. It could be used for so many other worthwhile things. But instead, it's used to pay interest on a national debt that shows no signs of slowing. And then worse still, you have the shackling of younger generations with financial burdens that are unfair and unsustainable. I'm quite surprised that the younger generation has not risen up and demanded some sort of accountability for this, because it is the young that are going to be inheriting this national debt. You know, it reminds me of an old quote by Herbert Hoover, ironically enough, who said, "Blessed are the young, for they shall inherit the national debt." Well, there's no doubt about that. They've certainly inherited a mess when it comes to a national debt. And I'm surprised that the younger generation is not making this an issue. And maybe there are a few, but you certainly don't hear it. And this is really where one of my real frustration lies with this topic, is the fact that we have both political parties here in the United States that have utterly failed to address this ticking time bomb. Republicans talk a big game about fiscal responsibility, right? They're always talking about how they're the party of fiscal responsibility, and they say that when it suits them politically. But yet when they're in power, their solution has too often been to cut taxes without corresponding spending cuts. And so thereby you end up increasing the debt, right? So they're very happy to cut taxes, and everybody likes tax cuts. But if you don't cut spending as well, you don't really solve any problem, right? And this, of course, is a political football. This is like a hot potato. No administration wants to cut spending. And so therefore, they'll just do things that'll pander to you, but they won't actually deal with the underlying problem. That's frustrating. Then you have the Democrats, on the other hand, who champion large-scale spending under the guise of investment, but they ultimately perpetuate this cycle of fiscal irresponsibility by, not being able to pay for these things. And so neither side is presenting a credible, comprehensive plan to pull us back from the brink. So let's just talk about a few facts about the national debt as we stand here in 2024. The U.S. national debt is projected to soar from 99% of GDP in 2024 to 122% of GDP in 2034, with the budget deficit expected to swell by more than $22 trillion over the next decade. I mean, that's incredible. Just over a decade, you're going to see $22 trillion in budget deficits, right? That is simply astonishing. And with the national debt now forecast to reach 106% of GDP by 2027, that's going to surpass the post-World War II high. So this trend is continuing, and it's showing us that debt levels are expected to increase despite economic growth. We are experiencing economic growth. We're just seeing it outpaced by the level of spending. Each and every year, we have a budget deficit here in the United States, which means we spent more than we took in. And you as a household, if you do that, you're going to go bankrupt. You'll lose your credit. You'll lose your house. You'll lose your car. You lose everything. You can't continue to spend more than you earn over and over and over again. And the United States is doing it because it can. But the question is how long can it do that? That's a really important question. And history tells us that you can't do it forever, right? You can't do it forever. Both President Biden and former President Trump have significantly contributed to the national debt. Trump's policies added $4 trillion, and Biden's policies have added $1.4 trillion in debt-financed spending. Proposed tax increases under Biden aims to reduce the debt by $3 trillion. But we really haven't seen that materialize. And then you have, unsustainable spending in terms of Social Security and Medicare, which are projected to increase their outlays by about $1 trillion each over the next decade. So, and then of course that's going to be aggravated and intensified by the demographic shift that we have here in the United States. We have an aging U.S. population, which is set to grow from 18% of the population to 23% over the next 3 decades. So 1 out of 4 people over the next 3 decades they'll be at an age where they could qualify for these Social Security and Medicare payments, which they have paid into the system. So the government's going to either have to break its promise or something else is going to break, right? Obviously, without some sort of change. And we look at the political situation today. Here we are in an election year, and neither party is talking about the national debt, right? It lacks any kind of serious debate. It lacks any kind of action on debt management. So even in this presidential election year, maybe perhaps especially in a presidential election year, they submerge this topic. They don't want to talk about it because both parties have contributed greatly to the current situation here with our debt. So we have this continued fiscal irresponsibility that I believe over time will lead to a loss of America's financial independence, and it could lead to a severe economic decline in the future. So we have this looming financial crisis that calls into question the politicians that we have in power, the policymakers who claim to be serious about fiscal responsibility, and yet they have no plan to solve it. They have no comprehensive plan to manage the debt effectively. So what about solutions? Solutions obviously are what we have to focus upon here in the United States. And in my book, Bankruptcy of Our Nation, it's filled with solutions. We list the real problems that are facing us, but then we get into the importance of solutions. What are some of the things that we can do here in the United States at the federal level to solve this problem? Well, obviously, they need to reform entitlement programs. And I hesitate to call Social Security or Medicare an entitlement program, even though that's often what they're called, because you and I both know that you paid money into Social Security, you paid money into Medicare. This is your money that they're paying back to you. And so therefore, to call it an entitlement is a little bit disparaging and, quite frankly, I think somewhat incorrect. But regardless, we need to reform these programs as they are major drivers of the national debt, and reforming these programs to ensure their sustainability. We need to keep these programs. These are great programs that people depend upon, but they have to be made more sustainable. They have to be brought up to the 21st century. We have to consider adjusting the benefits formulas. We have to consider increasing Medicare premiums if you cannot drive these healthcare costs down, but not for lower income beneficiaries, but for those with higher income. So those higher income beneficiaries could see higher Medicare premiums. There's a lot of things that can be done, but it's like a third rail that no politician wants to focus upon. Now, I also think that we should slash our defense spending. And I know that's unpopular, but to me, as a peacenik, I really look at the Department of Defense as one of the greatest areas of waste that we have here in Washington. So I do believe that the Defense Department, the Pentagon, which cannot pass an audit to save its soul, the spending needs to be re-examined and needs to be held accountable. We also need comprehensive tax reform. We need to broaden the tax base. We need to close loopholes. We need to simplify the tax code so that we can reduce evasion and increase compliance with the tax code and make it simpler. It's simply too crazy for people to understand, and there's too many loopholes for those who are savvy. Then we need to obviously reduce government spending. Look at discretionary spending. How can we cut unnecessary or inefficient programs and then maybe even make those programs more efficient, or just conduct a thorough audit of various federal agencies? These are things that need to be done. In addition to all of this, obviously you can cut spending and you can do all of that, but you also need to see Washington encouraging economic growth. And we have seen some of that as of late. We've seen some investments in infrastructure. We've seen some investments in technology. but we need much, much more. If we're going to grow our way out of this situation, it's going to take a lot of economic growth. And that means we're going to have to invest heavily in education. We're going to have to invest heavily in technology and innovation. That we need to enhance workforce skills. We need to, really focus upon, creating a higher national income so we can manage these debt levels, right? We could also even include some, clear rules and targets for debt and deficit levels that way we can enforce fiscal discipline. We could have spending caps and all of these things that you're not allowed to go beyond and spending targets and all of this. So these are some of the things, obviously, that the government can do. Well, you're not the government and you can't control the government. And so all you can do is control your own situation. So for you, you should be less concerned about the White House because you can't change it, and you should be more concerned about your house. So individuals, what can they do? What can they do to take precautions against what we see coming? Well, obviously, the first thing that you can do is reduce your own personal debt, right? The very high national debt is very likely going to lead to increased interest rates over time, and that's going to affect your personal debt. So paying off personal debts, especially those high interest debts, can protect you from those potential spikes in interest rates in the future. You can also increase your savings. We've been teaching the importance of saving money here at Follow the Money and investing for a very, very long time. So building a robust savings account, 6 months of liquid savings, keeping that, 6 months of your income in liquid savings and keeping that at all times. And then, of course, having a diversified investment portfolio, owning assets. Right now, those who own assets are doing much better than those who don't own assets. And if you look back through history, you'll find out that even in the worst of times, those who own assets do better than those who don't. Because even in times of like hyperinflation, asset prices go up, which serves as some form of inflation protection, right? So diversified investments, increasing your savings, reducing your debt, and focusing upon how you can build multiple streams of income, all the things we've been teaching you here for so long here at followthemoney.com. And in fact, we even have, for those of you who are struggling with debt out there today, we actually have a great resource for you for free on our website, followthemoney.com/debt. If you're really gung-ho about paying off your debt, I'm talking about mortgage debt, student loan debt, auto loan debt, personal debt, all that kind of stuff. Well, we have a very powerful strategy that can allow you to pay off everything all of your debt within, less than 10 years. And I'm talking even about your 30-year mortgage. We have a very cool debt stacking method that we put together here at Follow the Money that many people have used to pay off their debt very quickly. You can go to followthemoney.com/debt to get more information about that. Or maybe you don't have debt, or maybe you have manageable debt, but you're struggling to earn more income. And we can help there too, because we have an income university that we created here for our members many years ago, which covers 22 different income streams that you can create both now and in retirement. Our members have access to that. You can go to followthemoney.com/join, learn more about our plans and pricing, learn how you can create more income. We're here to help. We see the looming economic crisis with this national debt as something that everybody needs to be preparing for, that because Washington is not taking this seriously, you must take it seriously. It's going to hit us eventually in a very negative way, and it may come when we least expect it. So it's clear that without a dramatic shift in how Washington handles our finances here in the United States, we're steering straight into a storm. We need leaders willing to make tough, perhaps even unpopular decisions to secure our economic future, and we need them now, before this debt disaster grows even more out of control.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
right, friends, welcome back to one of the longest running personal finance podcasts on the web. You can find us online at followthemoney.com. You're listening to the Follow the Money podcast. My name is Jerry Robinson. I'm your host, author of the book Bankruptcy of Our Nation, and founder here at followthemoney.com, an investor, a trend trader. We have lots of courses on our website. You can check that out. We also have a great membership area for those who are wanting to learn more about trading and investing and creating income. Now, in our segment, we just finished our segment one. We talked about the U.S. national debt, and I should add, because we don't want to isolate the United States and act like it's the only nation that has a debt problem. We also have global debt now reaching $225 trillion, according to one metric. And that is simply astonishing. $225 trillion. The whole world is really awash with debt. And for this reason, it's incumbent upon you and I to have a financial plan. We simply can't wing it. We've got to actually have a plan. We've got to be vigilant and diligent and prepared for what could lie ahead. Very treacherous times right now in the global economy with the debt levels where they are. And again, those who own assets are doing better, faring better than those who don't. Now, in this segment number two, I want to get into a brief market update. I want to talk about what's been happening in the stock market. I also want to briefly talk about the crypto market. And by the way, we just released a completely free excerpt from our weekly members-only webcast. Every single Tuesday here at Follow the Money for our Gold and Platinum members, we have what we call our Trends and Profits webcast. And there we cover lots of different topics. We answer questions. We talk about investing ideas, trading ideas, income ideas, and much more. But we released an excerpt where we charted the markets. We went through many different markets and charts, and I gave my analysis on many different things. You can find that completely free on our YouTube page. You go to youtube.com/FTM for Follow the Money, FTM Daily, and that is our YouTube page. Or you can just search Jerry Robinson Follow the Money on YouTube. You'll find us. But our latest video we put out was on the topic of charting the markets. And so if you want to visualize some of these charts we're talking about today, be sure to check out that video at your leisure. Now let's get into some market commentary here. I want to look at several different markets briefly. The S&P 500 index, of course, the most important index for most investors as they want to monitor what's happening in the U.S. stock market. Most global investors turn to the S&P 500 to get a good idea of what's happening in the U.S. stock market, as 3 out of 4 stocks tend to follow the direction of the S&P 500. Now, the S&P 500 continues to power higher. We have seen that it is on pace for its best first half performance during an election year since 1976. So nearly 50 years since we've seen this kind of performance in the U.S. stock market in an election year. It's also the second best performance in an election year in its entire history. That's according to Dow Jones market data. And when we look at the S&P 500, we see it sitting right below 5,500, which it recently briefly touched. And it's really rallied strong, even just going back to, say, last October when this big rally really began. Of course, it probably continued, we should say, because we did see a rebound in the beginning of 2023. But if you go back to late 2023, the S&P was trading at about 4,100, 4,200. Now it's sitting at 5,400 in just 8 months or so. So we've had a really nice rally off of those October lows. And we're sitting at fresh record highs. Just below fresh record highs here on the S&P 500. Now, our members got an update from us, email alerts in January of 23 and June of 23, when we were telling our members that the stock market had formed a brand new major uptrend. Since that time, we've seen very good returns in the overall market. Now, when we look at the NASDAQ 100, that's one of my favorites. That's one that I invest in for the long term and also like to trade around. I use, the Invesco NASDAQ 100 ETF to do that. But when we look at the NASDAQ 100, it also just flirting with a 20,000 level, which it's never hit before. So the NASDAQ 100, very strongly positioned right now, moving very nicely. In fact, last week, you may have noticed that there was a lot of price action going on, a lot of volume, and that was because we went through the quarter's so-called triple witching. And that's when stock futures and index options contracts expire on the same day. And that triple witching can sometimes lead to very high volatility. Well, we saw a lot of volume last Friday, but even though last Friday was one of the really big days of the market for the year, this coming Friday, as I record this on the 26th of June, I'm referring to this Friday, the 28th, which will be the final trading day of June, but it will also be the final trading day of Q2, which means there'll be a lot of shifting around by asset managers and fund managers as they try to position for Q3. So this is going to be the end of Q2 on Friday. But then also, not just that, but Friday is also a big day before the rebalance of many indexes, including the Russell the Russell 1000, the Russell 2000. Many of these are going to be updated. We're going to see also some big moves in the technology sector ETF, where we're going to see a big shift towards NVIDIA and a diminishing of Apple in XLK. That's the ticker symbol. One ETF will need to acquire more than $10 billion worth of NVIDIA to align with its new weightings. So we expect that Friday and then next week, we could see a lot of price action and a lot of movement up, movement down, potentially volatility. But there's still a lot of money sitting on the sidelines here as we speak. There's over $6 trillion now sitting in money market funds. Much of those funds moved over in the wake of rising interest rates. People wanted to get that, those elevated CD rates or money market rates. But that's $6 trillion that could come pouring out of those funds as we begin to see rates come down. And the Fed very likely to begin slashing rates later this year, according to the latest data. On Friday, by the way, we will also get very important inflation data known as the PCE, the Personal Consumption Expenditure Index. Now, this is a very important index that the Federal Reserve looks at. It's its preferred inflation gauge as opposed to CPI. CPI, we did see a surprise to the downside. We also saw a surprise to the downside in PPI. That means that inflationary pressures are coming under some control. The PCE number, though, this Friday is going to be a real big deal, and that could lead to a big move in the dollar. The dollar has been picking up a little bit in recent weeks in the wake of the Fed's meeting, and we've seen it rally up to around 106 on the U.S. dollar index. Now, we don't expect it to get much higher than that. We think that we're going to see the dollar probably reverse course by Friday. Unless those numbers come out on Friday hotter than expected, we expect the dollar to go down. And if the dollar does go down in response to that Friday PCE figure, then we could see a pretty nice rebound, not only in equities, but also in commodities, gold, silver, oil, things along those lines that are priced denominated in the U.S. dollar. So the dollar has been showing some near-term strength, especially in the month of June, but we don't think that strength is going to remain. We don't think it's going to linger too long. So we'll be watching that dollar on Friday. For those of you watching gold, gold is just sitting right below that 2450 recent peak that it hit. That was a record high. It's been consolidating below that level now for a little bit. We think that it might continue to consolidate below that level for a little bit until we see some weakness in the dollar. Then we expect gold to blow past its 2450 level and move on to, say, 2500 or so, likely by the end of the year. Also, when we look at something like silver, we see that silver is also trading below its recent high of around $32.75. It's come down into the $28, $29 range. It's still locked in a nice uptrend and a bullish channel, but it is facing some near-term weakness. Silver overall is a very interesting metal. We've talked quite about it. Talked quite a bit about it in recent months. But we have seen a nice breakout on silver, a multi-year breakout that we had on silver that was achieved just a few months ago. We got above that $25 resistance, and now we've risen to an area that we haven't been at since 2012, right? So we're at 2012 levels currently, and so it's been 14 years since we've been at these levels that we are on silver. So silver, obviously an interesting market. We're continuing to monitor. Gold, we also continue to monitor as well. And the dollar, really watching that at that 106 level to see how it's going to react to the PCE numbers that come out this Friday. So a lot there to digest. Let's switch and let's just think about now how the markets have performed year to date. Right now, as we look at the major markets, silver is up more than 20% in 2024. That's a really good year. The NASDAQ 100 up nearly 18% this year. That's a very good year. The S&P up more than 15%. And then you look at something like the cryptocurrencies in the cryptocurrency space, Bitcoin up nearly 45%, Ethereum up nearly 47%. There's been quite a few things to talk about lately when it comes to Bitcoin, even though there hasn't been a lot of change in the price action. The price has really been grinding sideways now since it peaked out about 73,000, nearly 74,000 back in March. And since that time, we've just been grinding sideways in a what we would call a consolidation period. We've recently come down to the $59,000 level, but we seem to be holding that area. If you're looking at Bitcoin and you're looking at the price, you're a little concerned about it. The two support levels we're watching are 59,000 and 50,000. Both of these very, very important numbers on the chart. Bitcoin, by the way, is becoming an election issue in 2024. Both Trump and Biden are or will be accepting cryptocurrency donations, and that validates the technology here, blockchain technology. So that's really been an interesting thing. We've even heard that President Trump may be speaking next month at the Bitcoin conference in Nashville, the annual Bitcoin conference put on by Bitcoin Magazine. We've also heard that President Biden will be meeting with crypto executives at a roundtable next month. And we've also seen the Biden administration really call off the dogs when it comes to crypto. We've seen the SEC, which has been a very aggressive and very opaque regulator towards the crypto space, suspend recently their investigation into Ethereum 2.0, basically admitting that it's a commodity and not something that they should be regulating. We've also seen them relax rules around spot Ethereum ETFs, paving the way for their approval, maybe as early as next month, maybe August. So we'll see those spot Ethereum ETFs. We don't expect those to be as in demand as spot Bitcoin ETFs, but nonetheless, we're seeing really a breakdown of the resistance that has really been strong in Washington towards crypto up until recently, even to the point where Biden's campaign is in talks to accept crypto donations through Coinbase Commerce. And so, we have a lot there. Then we have, many things happening in the corporate space where you have T-Mobile, for example, announcing that it's beginning to mine Bitcoin. We have Standard Chartered Bank, which, has around $800 billion in assets. We've learned that they're building a spot Bitcoin trading desk. That's according to Bloomberg. We've heard Fidelity's director of global macro call Bitcoin exponential gold. We have Bernstein, another big financial firm, nearly $800 billion financial firm, is basically forecasting that Bitcoin is going to hit $1 million and is predicting a $200,000 price tag on Bitcoin by next year. We also heard that Australia's largest stock exchange has approved its first spot Bitcoin ETF. So there's been a lot happening on the news front when it comes to Bitcoin, but the price of Bitcoin has really just been grinding sideways, as I had told you, between that $59,000 support range and all the way up to about nearly $74,000. Lots of grinding sideways in that box. But Bitcoin, quite frankly, is very interesting because it's growing faster than the internet. And when the internet, of course, was adopted, it was pretty rapid adoption. Each year we saw more and more people getting online. Well, we're seeing the same kind of growth in the Bitcoin network, but it's actually faster than what we saw with the internet. And we find that to be very interesting. We have been talking about Bitcoin on this podcast for over a decade, maybe even 12 years now. Many of our listeners knew about Bitcoin when it was very simple to buy 1, 2, 3, 4, or even 10. Many of our members were able to buy Bitcoin well before it even got to 4 figures or 5 figures. So we've been watching that, and many of our members did the same thing with Ethereum. We were talking about Ethereum when it was $12, right? So these are things that we've been watching for a long time. We've been observing, we've been talking about, and we continue to see higher prices ahead. We are forecasting a north of $200,000 price tag on Bitcoin, along with Bernstein. We agree with them that Bitcoin will be over $200,000 sometime next year, maybe by the fall is when we would expect that. Late summer, early fall is very likely when we'll see that. But if you're following Bitcoin, 59,000 support is the very first key level to watch, down to about $50,000. I would be watching for support in that range. And then if you're watching Ethereum, Ethereum all the way down to about 3,100, we could probably see that price fall. But as we get closer to the approval of these spot Ethereum ETFs, and as we get closer to those rate cuts, I think you're going to see Ethereum pick up as well. Now, we follow many different cryptocurrencies for our members. We have a crypto leaderboard for every single week. We put out a ranking list of the top ranked cryptocurrencies. We put out a list of, for those who prefer to follow the stock market, we put out a list of the top ranked ETFs. We also put out top-ranked dividend aristocrats. I mean, we just have tons of stuff for our members. If you're not a member here at Follow the Money, do yourself a favor and learn more about us, followthemoney.com/join. We'd love to have you here and welcome you into our community. Well, friends, as we wrap up today's episode on America's soaring national debt, let's reflect on the broader implications here of our financial behaviors, both at the national and individual level. It's easy to criticize Washington's fiscal irresponsibility, but perhaps it's time to also look at our own personal economic strategies. Consider this thought-provoking analogy I came across that likens our own economic behavior to a game of Monopoly. It goes like this. Imagine playing Monopoly and never buying any assets or investments that generate income. Imagine you just went around the board collecting $200, giving your money to the rich, and trying to stay out of jail. That is how most people live their life. It's kind of a sad commentary, but we can't say that it's not true. What this tells us is that while we are quick to point fingers at the government for fiscal mismanagement, we often follow a similar pattern in our own financial lives by avoiding investments and easy spending rather than saving or building wealth. If we want to protect ourselves from the fallout of national financial decisions, it's crucial, I believe, to become proactive about our own economic choices. This means educating ourselves about investing by being mindful of our spending and planning for our future rather than just drifting through the landscape. So as we consider the big challenges posed by our national debt, let's also take a moment to reflect on our own personal financial health. Are we just passing go and collecting $200? Or are we strategically acquiring assets that will generate long-term income and that we can pass on to future generations? It's something to ponder as we aim to not only survive, but thrive amidst economic uncertainty. And that's just something to think about. Well, thank you so much for tuning in to this episode of Follow the Money podcast. Today's discussion is a reminder of the power and impact of the financial decisions, both big and small, that you and I make on a daily basis. It's been great to have you here for this podcast episode. And remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week. Until next time, friends, I'm Jerry Robinson wishing you good health and great success. God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any